Good evening, everyone, and welcome back to Market Meridian Finance, your trusted source for no-nonsense, actionable investment advice that turns everyday savings into long-term wealth. I'm your host, Eric, and tonight, we are tackling a question that's been flooding our inbox lately. I have $5,000 in savings. How, where, what, why, and when should I invest it in the stock market? Let me start by saying this. $5,000 is not a small amount of money. It's a powerful starting point, one that, with the right strategy, can grow into a six-figure nest egg over time. But here's the truth. 90% of new investors mess this up. They either rush in blindly, chase hot tips that fizzle out, or let fear paralyze them into doing nothing at all. Tonight, we are going to fix that. We are going to break down every piece of the puzzle, step by step, in plain English, so you can invest your $5,000 with confidence, clarity, and a proven plan. Before we dive in, let's set the stage. The stock market is not a get-rich-quick scheme. It's a wealth-building tool, one that rewards patience, discipline, and diversification. If you're here looking for a way to turn $5,000 into $50,000 in 6 months, this episode isn't for you. But if you're here to learn how to grow that $5,000 steadily, safely, and sustainably over 5, 10, or 20 years, stick around. This is the most important 30 minutes you'll spend on your financial future this week. Let's start with the basics. Before you even think about investing a single dollar in the stock market, you need to check 2 critical boxes. These are non-negotiables. Skip them, and you're setting yourself up for failure. First, do you have an emergency fund? I'm talking 3 to 6 months of essential expenses, rent, food, utilities, medical bills, stashed in a high-yield savings account, where it's easily accessible and won't lose value. Why? Because the stock market is volatile. It can drop 20% in a matter of weeks, and if you're forced to sell your investments to cover an unexpected expense during a downturn, you'll lock in those losses permanently. You don't want to be that investor who sells low because life threw a curveball. So, if you don't have that emergency fund yet, pause. Use part of your $5,000 to build it first. Trust me, your future self will thank you. Second, do you have high-interest debt? Think credit cards, payday loans, or personal loans with an interest rate above 7%. If you do, pay that off before you invest. Here's why. The average annual return of the S&P 500 over the long term is about 10%. If you're paying 15% interest on a credit card, you're losing money faster than you could ever earn it in the stock market. It's like trying to fill a bucket with a hole in the bottom. No matter how much you pour in, it'll never fill up. So, pay off that high-interest debt first. Once you've checked these 2 boxes, emergency fund in place, high-interest debt gone, you're ready to invest your $5,000 wisely. Now, let's get to the first big question. How to invest your $5,000. This is where most new investors get overwhelmed. They log onto a brokerage app, see thousands of stocks and funds, and have no idea where to start. But the process is simpler than you think. If you follow this 4-step plan, Step 1, open a low-cost online brokerage account. Gone are the days of paying $10 per trade or needing a minimum balance of $10,000 to invest. Today, there are dozens of reputable brokerages that offer $0 commissions on stocks and ETFs, allow fractional shares, so you can buy $50 of a $300 ETF, and have no minimum balance requirements. The key here is to choose a platform that's user-friendly, secure, and has low expense ratios. Our top picks for beginners? Fidelity, Vanguard, Schwab, and Interactive Brokers, if you're an international viewer. These platforms are trusted by millions of investors, offer robust educational resources, and won't nickel and dime you with hidden fees. Opening an account takes 10 to 15 minutes. You'll need a government-issued ID, your social security number, or equivalent, and a bank account to fund it. It's that easy. Step 2. Use dollar cost averaging, DCA. Let me ask you a question. When you go to the beach, do you close your eyes and take the big plunge, or do you dip a toe in the water first to test the temperature? For most of us, it's the latter, and investing should be no different. Many new investors make the mistake of dumping all $5,000 into the market at once, hoping to buy low and sell high. But here's the problem. No one, not even the so-called experts, can time the market. You might invest all your money right before a market crash, or miss out on gains if the market keeps rising. Dollar cost averaging solves this problem. Instead of investing $5,000 all at once, you split it into 5 to 10 equal monthly installments, $500 to $1,000 per month, and invest that amount on the same day every month, regardless of market conditions. When the market is down, your $500 buys more shares. When the market is up, it buys fewer shares. Over time, this averages out your entry price, reduces the impact of volatility, and takes the emotion out of investing. It's like planting a seed every month. Over time, those seeds grow into a forest. And here's a little-known fact. You might already be using DCA without even realizing it. If you contribute to a 401k or other retirement account from your paycheck every month, that's DCA in action. It's a proven strategy that works for beginners and seasoned investors alike. Step 3. Place your orders correctly. Once you've set up your DCA plan, it's time to place your trades. For beginners, we recommend using a market order. This means you buy the ETF or stock at the current market price, which is ideal for ETFs during market hours, 9:30 a.m. to 4 p.m. Eastern Time. If you're investing outside of market hours, you can use a limit order, which lets you set a specific price you're willing to pay. But for most beginners, market orders are simpler and more straightforward. Also, make sure to enable fractional shares on your brokerage account. This lets you invest exact dollar amounts, even if the ETF or stock is expensive. For example, if an S&P 500 ETF is trading at $300 per share, you can invest $500 and get 1.67 shares. You don't have to buy a full share. This is a game changer for small investors, as it lets you diversify your portfolio even with a small amount of money. Step 4. Automate everything. The biggest enemy of successful investing is emotion. Fear, greed, panic, overconfidence. The best way to beat emotion is to automate your investments. Set up automatic transfers from your bank account to your brokerage account on the same day every month, and set up automatic purchases of your chosen ETFs. This way, you don't have to think about it. You're investing consistently, even when life gets busy, and even when the market is volatile. Automation turns investing into a habit, and habits are what build long-term wealth. Now that we've covered how to invest, let's move on to the second question: where to invest your $5,000. When we talk about where, we are talking about which markets to focus on, and which to avoid. For beginners with $5,000, the goal is to stick to liquid, well-regulated markets that offer long-term growth potential. Here's our breakdown. First and foremost, the U.S. stock market, NYSE and NASDAQ. This is the largest, most liquid stock market in the world, with strong regulatory oversight and a long history of growth. The U.S. market is home to some of the most valuable companies in the world: Apple, Microsoft, Amazon, Google, and Tesla, to name a few. Over the long term, the S&P 500, which tracks the 500 largest U.S. companies, has delivered an average annual return of about 10%. That's enough to double your money every 7 years, thanks to compound interest. For most beginners, the U.S. market should be the foundation of your portfolio. It's stable, it's predictable, and it's proven to grow over time. Second, developed international markets. While the U.S. market is strong, it's never a good idea to put all your eggs in one basket. Diversifying into developed markets, like Europe, Japan, and Canada, reduces your risk and gives you exposure to companies that might not be available in the US. For example, companies like Nestle, Switzerland, Toyota, Japan, and L'Oréal, France, are global leaders in their industries, and investing in them lets you benefit from their growth. The key here is to invest in low-cost ETFs that track these markets, so you don't have to pick individual stocks in foreign countries. Third, emerging markets, optional. Emerging markets, like China, India, Brazil, and Southeast Asia, offer higher growth potential than developed markets, but they also come with higher risk. These markets are more volatile, have less regulatory oversight, and can be affected by political instability or economic crises. For beginners, we recommend limiting emerging markets to 0 to 10% of your portfolio, if you choose to invest in them at all. If you're risk-averse, you can skip them entirely. Your portfolio will still grow steadily with US and developed international markets. Now, let's talk about where not to invest. Avoid illiquid penny stocks. These are stocks of small, unproven companies that trade for less than $5 per share. They're highly volatile, often manipulated, and 99% of them lose value over time. Avoid unregulated exchanges. Stick to reputable platforms like the NYSE, NASDAQ, or European exchanges. And avoid high-fee managed funds. These are funds where a professional manager picks stocks, but they charge high fees, often 1% to 2% per year, and consistently underperform the market. Remember, the less you pay in fees, the more of your returns stay in your pocket. Next up, the most important question for beginners: what to invest in. With $5,000, you don't have the luxury of buying dozens of individual stocks, and even if you did, you shouldn't. Individual stocks are risky. One bad earnings report, one scandal, or one economic downturn can cause a single stock to drop 50% or more overnight. For beginners, the best approach is to invest in low-cost, diversified ETFs, exchange-traded funds. An ETF is a basket of stocks or bonds that trades on an exchange, like a stock. It lets you invest in hundreds or thousands of companies with a single purchase, which eliminates single company risk. And because ETFs are passively managed, they track an index, like the S&P 500, they have extremely low expense ratios, often less than 0.1% per year. Warren Buffett, one of the most successful investors of all time, has repeatedly said that most investors, including institutional investors, are better off investing in low-cost index ETFs. In 2007, he made a bet that an S&P 500 index fund would outperform a basket of hedge funds over 10 years, and he won decisively. The hedge funds had average returns of 3.6% per year, while the S&P 500 index fund returned 7.1% per year. That's the power of passive investing. Buffett even went so far as to say that his will specifies that 90% of his personal wealth should be invested in an S&P 500 index fund for his wife after he passes away. If it's good enough for Buffett, it's good enough for you. So, what's the perfect ETF portfolio for $5,000? We recommend a lazy portfolio, a simple 3 ETF combination that's proven to beat 80% of active fund managers over time. Let's break it down. First, S&P 500 ETF. 60% of your $5,000 equals $3,000. The S&P 500 tracks the 500 largest U.S. companies, covering every major sector: technology, healthcare, finance, consumer goods, and more. This is the core of your portfolio, as it gives you exposure to the U.S. economy's growth. Our top picks here are VOO, Vanguard S&P 500 ETF, IVV, iShares Core S&P 500 ETF, and SPY, SPDR S&P 500 ETF. All three have expense ratios between 0.03% and 0.09%. That's just $3 to $9 per year for every $10,000 invested. To put that in perspective, if you invest $3,000 in VOO, you'll pay just 90 cents per year in fees. That's negligible compared to the long-term returns you'll earn. Second, total U.S. stock market ETF. 20% of your $5,000 equals $1,000. While the S&P 500 covers large-cap companies, a total U.S. stock market ETF covers large, mid, and small-cap companies. This gives you exposure to smaller, faster-growing companies that might not be in the S&P 500, companies that could become the next Apple or Microsoft. Our top picks here are VTI, Vanguard Total Stock Market ETF, and ITOT, iShares Core S&P Total U.S. Stock Market ETF. Both have expense ratios around 0.03% to 0.05%, and they track every publicly traded U.S. company. Adding this ETF to your portfolio increases diversification and gives you more growth potential. Third, International Developed Markets ETF. 20% of your $5,000 equals $1,000. As we mentioned earlier, diversifying into international markets reduces your risk and gives you exposure to global companies. Our top picks here are VEA, Vanguard FTSE Developed Markets ETF, and EFA, iShares MSCI EF ETF. These ETFs track companies in Europe, Japan, Canada, and other developed countries, and they have expense ratios between 0.05% and 0.08%. This ETF ensures that your portfolio isn't overly dependent on the U.S. market. If the U.S. market has a down year, your international investments might offset those losses. Let's do the math to make this concrete. If you split your $5,000 into 10 monthly installments of $500, each month you'd invest $300 in VOO, 60%, $100 in VTI, 20%, and $100 in VEA, 20%. Over 10 months, you'd have fully invested your $5,000, and you'd own a diversified portfolio of thousands of U.S. and international companies, all with minimal fees. This portfolio is simple to manage, requires no research, and has a long history of strong returns. Now, let's talk about optional add-ons, if you want to add a little extra growth or income to your portfolio. These are optional, and we only recommend them if you're comfortable with a bit more risk. First, NASDAQ 100 ETF, QQQ. This ETF tracks the 100 largest non-financial companies on the NASDAQ, which are mostly technology and growth companies, like Apple, Microsoft, Amazon, and Google. It has a higher volatility than the S&P 500, but it also has higher long-term returns. You could allocate 5% to 10% of your portfolio to QQQ if you want more exposure to tech. Second, Dividend ETF, SCHD or VYM. These ETFs invest in companies that pay consistent dividends, like Coca-Cola, Johnson & Johnson, and Procter & Gamble. Dividends are a great way to generate passive income, and they can help cushion your portfolio during market downturns. Third, Small Cap ETF, VB or IJR. Small cap companies are smaller, faster-growing companies that have more growth potential than large cap companies, though they're also more volatile. You could allocate 5% to 10% of your portfolio to a small cap ETF if you're willing to take on more risk for higher potential returns. But here's a critical rule. Do not invest in individual stocks unless you have 100+ hours per year to research them. 90% of retail investors lose money picking individual stocks. Even professional fund managers struggle to beat the market. For example, if you invest $5,000 in a single tech stock and that company's product fails, you could lose all your money. But if you invest $5,000 in an S&P 500 ETF, even if one company fails, it will have almost no impact on your portfolio. Stick to ETFs. They're the safest, simplest way for beginners to invest. Also, avoid leveraged ETFs, options, crypto, or meme stocks. These are extremely risky. They can multiply your gains, but they can also multiply your losses. Leveraged ETFs use borrowed money to amplify returns, which means a small market downturn can wipe out your entire investment. Options are complex financial instruments that even experienced investors struggle with. Crypto and meme stocks are highly volatile and have no intrinsic value. They're speculative, not investments. Save these for when you have more experience and a larger portfolio. Now, let's move on to the why behind this strategy, because understanding why you're investing a certain way is just as important as how you're investing. Let's break down the rationale behind our recommendations. First, why ETFs over individual stocks? We've touched on this, but it's worth repeating. ETFs offer three key advantages: diversification, low cost, and proven performance. Diversification means you're not putting all your eggs in one basket. One ETF owns 500 plus stocks, so you're protected from single company risk. Low cost means more of your returns stay in your pocket. ETFs have expense ratios that are 10 to 20 times cheaper than active mutual funds. And proven performance. The S&P 500 has beaten 80% of active fund managers over 10 plus years. Active managers charge high fees to pick stocks, but they can't consistently beat the market. ETFs, on the other hand, track the market, so you get market returns without the high fees. It's a no-brainer for beginners. Second, why long-term investing, 5+ years? The stock market is volatile in the short term. It can drop 20% to 30% in a bear market, and it can swing up and down by 1% to 2% every day. But over the long term, 5, 10, 20 years, the stock market has always recovered and hit new highs. For example, during the 2008 financial crisis, the S&P 500 dropped 57%, but it recovered all its losses by 2013. During the 2020 COVID crash, it dropped 34%, but it recovered in just 6 months. If you had sold your investments during either of these downturns, you would have locked in massive losses. But if you held on, you would have recovered your money and continued to grow. The key is to have a time horizon of at least 5 years. This gives the market time to weather short-term volatility and deliver long-term growth. Trying to time the market is a losing game for 99% of investors. Time in the market beats timing the market every single time. Third, why DCA over lump sum? Earlier, we compared DCA to dipping your toe in the water instead of taking a big plunge. Academically, lump sum investing all $5,000 at once, beats DCA about 66% of the time. Because the market has an upward bias, it tends to go up more than it goes down. But here's the catch. DCA is better for behavioral consistency. Most investors can't handle the emotional stress of investing all their money at once and watching it drop 20% in a month. DCA takes the emotion out of investing. It lets you invest consistently, regardless of market conditions, and it reduces the risk of investing all your money right before a crash. For beginners, behavioral consistency is more important than maximizing returns in the short term. It's better to invest consistently with DCA than to try lump sum and panic sell during a downturn. Remember, investing is a marathon, not a sprint. DCA helps you stay in the race. Fourth, why low fees? Fees might seem small, but they compound over time and eat into your returns. Let's say you invest $5,000 at a 10% annual return. If you pay a 0.05% expense ratio, like VOO, after 20 years, your investment will grow to about $33,637. But if you pay a 1% expense ratio, like many active mutual funds, after 20 years, your investment will grow to about $27,126. That's a difference of $6,511, all because of fees. Over 30 years, the difference is even bigger, $87,247 with a 0.05% fee vs. $66,211 with a 1% fee. That's a difference of $21,036. Enough to buy a car, a down payment on a house, or fund your retirement for a year. Fees matter, so always choose the lowest cost ETFs you can find. Now, let's tackle the final question: when to invest your $5,000? The short answer: now, regardless of market conditions. But let's break this down, because it's one of the most common questions we get. When should you start investing? The best time to start investing was 10 years ago. The second best time is today. Here's why. The biggest risk in investing is not investing at all. Every day you wait, you're missing out on compound growth. Compound growth is the eighth wonder of the world. Your money earns interest on interest, and over time, it grows exponentially. For example, if you invest $5,000 at a 10% annual return, it will grow to about $12,969 in 10 years, $33,637 in 20 years, and $87,247 in 30 years. But if you wait 5 years to start investing, that $5,000 will only grow to about $67,275 in 30 years. You'll miss out on $19,972 in growth. That's the cost of waiting. So, don't wait for the perfect time to invest. There is no perfect time. The market will always be too high, too low, or too volatile. The only perfect time is now. What if the market is at an all-time high? Should you wait for a crash? No. Because no one knows when a crash will happen. The market has hit all-time highs thousands of times throughout history, and it has always continued to grow. For example, if you had invested $5,000 in the S&P 500 at its all-time high in 2007, right before the financial crisis, by 2023, that $5,000 would have grown to about $15,000, even after the 57% crash. If you had waited for a crash, you might have missed out on years of growth. The key is to invest consistently, regardless of market highs or lows. When the market is high, you're buying fewer shares, but those shares will still grow over time. When the market is low, you're buying more shares at a discount. That's when you're getting the best value. What about when the market is crashing? Should you sell your investments to avoid losses? Absolutely not. Selling during a crash is the worst thing you can do. It locks in your losses and prevents you from benefiting from the recovery. Remember, bear markets are rare, short-lived, and the best times to accumulate shares. For example, during the 2020 COVID crash, the S&P 500 dropped 34% in just a month. But investors who kept investing during that crash bought shares at a steep discount, and by the end of the year, the market had recovered all its losses. Those investors made a fortune. The key is to stay calm, keep investing, and remember that the market always recovers. When should you sell your investments? The only time you should sell is when you need the money, and your time horizon is less than 3 years, or when the ETF's core strategy changes, which is rare for index ETFs. For example, if you're saving for a down payment on a house and you need the money in 2 years, you should sell your investments and move the money to a high-yield savings account, because the stock market could crash in those 2 years, and you don't want to risk losing your down payment. But if you're investing for retirement, which is 20 or 30 years away, you should never sell, even during market crashes. You should hold on and let your investments grow. Another important part of when is rebalancing your portfolio. Rebalancing means adjusting your allocations back to your target percentages: 60% S&P 500, 20% total U.S. stock market, 20% international developed markets, once a year. For example, if the S&P 500 grows to 70% of your portfolio because the tech sector had a strong year, you would sell 10% of your S&P 500 ETF and buy more of your total U.S. stock market and international ETFs to get back to 60-20-20. Rebalancing ensures that your portfolio doesn't become too risky. When one asset class grows too much, you sell high and buy low, which improves your long-term returns. It's a simple, disciplined way to keep your portfolio on track. Now, let's talk about a critical topic that we can't ignore: avoiding scams. Every day, new investors are targeted by those who promise guaranteed returns or insider tips. They are scammers. Here's how to spot a scam. If someone says internal ticket, institutional positioning, profit sharing first, no profit no fee, or asks you to download a private app or join a VIP group, run. Legitimate investment. Professionals never promise returns, never charge profit sharing fees, and never ask you to use unregulated platforms. Always check the credentials of anyone giving you investment advice, and only use reputable brokerages. If something sounds too good to be true, it is. Let's wrap this up with a step-by-step summary of your $5,000 investment plan, so you can walk away from this episode with a clear, actionable plan. 1. Check your financial foundation. Make sure you have a 3 to 6 month emergency fund and pay off any high-interest debt, above 7%, before investing. 2. Open a low-cost brokerage account. Choose Fidelity, Vanguard, Schwab, or Interactive Brokers. Look for $0 commissions, fractional shares, and low expense ratios. 3. Set up dollar cost averaging. Split your $5,000 into 10 monthly installments of $500, or 5 installments of $1,000. Invest the same amount every month, regardless of market conditions. 4. Build your portfolio. Invest 60%, $3,000 total, in an S&P 500 ETF, VOO, IVV, or SPY, 20%, $1,000 total, in a total U.S. stock market ETF, VTI or ITOT, and 20%, $1,000 total, in an international developed markets ETF, VEA or EFA. 5. Automate everything. Set up automatic transfers from your bank account to your brokerage account, and automatic purchases of your ETFs. This eliminates emotion and ensures consistency. 6. Hold for the long term. Commit to 5+ years. Ignore daily, weekly, or monthly market noise. Rebalance your portfolio once a year to keep your allocations on track. 7. Avoid scams and risky investments. Stay away from penny stocks, leveraged ETFs, options, crypto, meme stocks, and anyone promising guaranteed returns. Let me leave you with this. Investing is not about being perfect. It's about being consistent. You don't need to have a PhD in finance, you don't need to pick the next big stock, and you don't need to time the market. All you need to do is start early, invest consistently, keep fees low, and stay disciplined. Your $5,000 today is the foundation of your financial future. In 10 years, you'll look back and be grateful you took this step. In 20 years, you'll be amazed at how much it's grown. Before we go, let's answer a few viewer questions we received this week. First, from Sarah in Chicago. I'm 25 years old. Should I invest more in growth ETFs like QQQ? Sarah, great question. At 25, you have a long time horizon, 35+ years until retirement, so you can afford to take a little more risk. You could allocate 10% to 15% of your portfolio to QQQ for extra growth. Just make sure the core of your portfolio is still the 3 ETFs we recommended. Second, from Michael in Toronto. Can I use this strategy if I'm investing in Canadian dollars? Absolutely, Michael. Most brokerages let you convert Canadian dollars to US dollars, with low fees, or you can invest in Canadian-listed ETFs that track the S&P 500 and international markets. The strategy is the same: diversify, keep fees low, and invest consistently. If you have a question for next week's episode, leave it in the comments below. And don't forget to subscribe to Market Meridian Finance. We release new episodes every Wednesday and Friday, with actionable investment advice for beginners and seasoned investors alike. Hit the notification bell so you never miss an episode. Remember, the best investment you can make is in yourself. By taking the time to learn how to invest wisely, You're setting yourself up for a lifetime of financial security. $5,000 is just the beginning. With consistency and discipline, you can turn that into a fortune. Thank you for joining us tonight. I'm Eric, and we'll see you next time on Market Meridian Finance, where we turn your savings into wealth.